So today, we are going to hopefully finish the handout today. We'll see. But continue with the handout on chapter 6, which is all about inventory and selling inventory. And the problem are the costs. The revenues are really easy, whatever you sold the thing for, it's really easy. But the excuse me, the costs are the hard thing. It sounds very strange, but one of the hardest things you can ask people, somebody, is what does it cost? You know, what does it cost? Just what does it cost? It's not so easy because they can move all over the place. And you know, if you and the more complex the item is, the more the more variation you can get in it. So anyway, let's go ahead and pull up. So we got up through page, I think, 3. All right, so we're on page 4. And so the method we're using, and by the way, and here's the problem. Just to reiterate what we did last time. The problem is this. That all these goods that we've purchased to sell, so we're going to resell these, they can have different costs. If the costs are all the same, like on problems 1 and 2, there's not a problem. But it's when the costs change that there's a problem. Because when you sell these 80 units, oops, no, I don't want that. You gotta know which units you sold, right? You have all these units down here that you can sell. Which of those are from that 80, you know, those 80 units that you sold, which ones are they? And generally speaking, first in, first out is probably the way they are sold. But the first one's in or the first one's sold. If you made a sale on, say, you know, here's January 1st, we had 30 units. So if you made a sale on January 10th, it must have come from those 30 units because the rest of these weren't there yet, right? So first in, first out is probably the actual way that the most inventory, the actual way that inventory usually leaves the place. The first ones in are the first ones that you sell. They have to be in some cases because you don't have the other ones yet. So if you make a sale on January 10th, it has to come from those 30. These other ones didn't arrive, you know, it didn't arrive for 3 more days. So if you sold one, it came from the first inventory. So first in, first out is probably, you know, the actual flow of goods. It probably matches it the best. And we say first in, first out. What we're really talking about are the first ones in with the first ones sold. So out is the same as sold. So first in, first sold. So you want probably the only way, why don't we have it, call it FIFEs? I don't know, FIFO sounds cooler, I think. So anyway, so this is the problem here we have, is that when these costs change, and they will, how do you account for that? Okay, and again, the sales are the easy part, so we'll do the easy part first. And I'll send those exams to your personal email, the 3 and 4 exams, and then but I'm also going to open up a ticket with the help desk, because if it's only for my class, then it'll be my help ticket. Okay, so we have sales.
Thank you.
You're welcome. Okay, so for January, sold 80 units. Selling price, $35 each. Let's give us the total sales. For my calculator cam. Oops, turn on the calculator. Write that down, guys. Write down the calculator. Yeah, turn on the calculator first. Okay. 800. Okay, so these are the sales. Okay, so we have total, I can use the January too, might as well. Everything green. Okay, so the sales are the easy ones. It's not hard to get the sales. Now, for the really hard part, it is going to be this. Oops. Okay, so it kind of looks like this. We have units. This is the cost of goods sold. Oops. Okay, and we need the cost for, and we started out with the 80 units that we have here. So we sold 80 units. We have to find the cost of those. You're saying, I don't know. You guys get the idea. So we sold 80, so we have to find the cost for these. Now, for the tricky part, which ones were the first ones in?
The 30 units and 60 units.
Yep. So these were the first in. So we're going to start here. So we're going to go to this layer, the beginning inventory. I'm just going to copy because I'm lazy. Now, notice we can't get all 80 units. There's only 30 in that layer. The price is $15. I'll do the calculations later. Okay, so we still need the cost for some more, right? So how many more do we need the cost for?
50.
Yeah. So we found the cost of 30 of these, right? So 30, we found the cost for 30 of them. So we still need the cost for 50. Now, think about this. This layer is completely gone. Wait a minute, I'm doing the wrong thing here. So that layer is gone and it's never coming back. So that beginning inventory is completely sold. We're never going to see it again. The 15s are done. No more $15 items. Okay, so the next place we go to is,
Professor, what question is this?
number 4.
Okay.
And this is I moved up my spacing here. Oops. Okay, so where are we going to go to next? I think you already said it. Yep.
The 60 units that cost 20.
Yeah, and good. We are not taking all of these because I think I'm gonna make this a different color. I'll make this blue. Or not turquoise or whatever you call it. Okay, so this is. Okay, so the next layer we're going to go to is this one, purchase inventory. Okay, so we take this one. And again, we don't need all 60, we only need 50 of those. So we'll take the 50 that we need. There's enough in there to cover that. And the price is 20. And you don't need to put this in, but I'm going to put it in there just because wacky. So you don't need to find the cost anymore. So let me see if I can do this without making it look like a mess. I guess the answer is no, I can't do this without making it look like a mess. All right, so this is that looks terrible. I'm going to change this back to yellow. Okay. So unit cost for 80 units. We got 30 of them from the first layer. We have 60 in the second layer. We don't need all 60 though. We only need 50. You know, these two have to add up to 80, and they do, right? 30 plus 50 equals 80. So we found the cost for those. So I took the first two layers, and then we're going to think, excuse me, have to calculate these out. All right, 30 times 15, 450. Better use Mr. Calculator. 450. 50 times 20 is 1,000. Okay, so the total. Any questions on that?
Nope.
So our sales are 2,800. Our total costs was 1,450. So we can do our gross profit here. Cost of goods sold, in other words, what are we sold? What did it cost us? And it cost us 1,450. Now, remember, these are things going out. You know, if I sell this little toy, if I sell this toy to somebody, you know, remember this toy leaves. Whoever, you know, the customer that bought this is taking it with them. So cost of goods sold is the cost of whatever it is. So as an example, this would be like the 1,450, you know, the cost of it, and people have taken those out. So it's no longer in the building. So it isn't cash going out. It's this, you know, inventory, the goods that are leaving the place. So cost of goods sold is so that's why it's a negative here. So those are items that have left the place. And this will give us our gross profit. Which would be, was it 1,350? Better use a calculator. So this is how much profit they made on those goods, whatever it is. They don't tell us what they sold, but whatever it was, that's how much they made for it. Now, ending inventory. This is tricky because we have to clean this up a little bit up here. We don't have 60 of this inventory anymore. How much do we have?
10.
Yep. Because remember, we sold oops. Ah. So we're only left with 10. Now, if I guess I should probably do it for this one too, just to kind of show you exactly what, you know, it'll be the same kind of a thing. The only difference is that this one is sold all the way out to 0, right? So this one's gone. So this first one is gone completely, right? There's 30 in there, we sold 30. So, so this inventory is, like I say, it's gone. There's nothing there left. This one, we still have these left. So we still have this left. And this left. Do the ending inventory, and I am going to cheat and move this down here just so it's kind of on the same screen. So the ending inventory in other words, the stuff that was not sold would be this. We still have 10 from there. This. Ah. Okay. And this would be the total cost of the ending inventory. Ten times 20, 200. 7 times 25 is some number I should know, but it's not popping in my head. 1750. So those two together would be 19. So this will be the total ending inventory. So we're really just looking at those things that were not sold. Yeah, so these were still not sold. We still have them. We can sell them. Which one's going to be the beginning, the first in starting in February? Which layer of inventory is going to be the first ones in?
The January 13th.
Yep. Yeah, these are going to become for the next month going into February. So this is January. We go down to February. These are going to be the earliest ones we have. So those will be the first in, then we'll go to this one and so on and so forth. So you just keep selling, the first ones that were in are the first ones that are sold. And again, this is probably close to the actual flow of inventory. Usually the first ones in are the first ones sold. Okay. So this next one.
Professor, can you quickly scroll back up to for C? I just wanted to see something.
See, yeah,
If I did something. Okay, thank you.
you're welcome. Yeah, so they'll have these different layers. In accounting, they call those pools, inventory pools. So those will be, I don't know why they call it pools, but they'll pool. Sometimes they'll pool for an entire month. Sometimes they'll just pool for each purchase, and they'll call these a pool. I like to think of them as layers, just because it seems like you take them by layer. Other people call it layers too sometimes. Okay, so I think I'll be quiet and see if you can figure out number 5. So these are what were sold. So the sales are easy. Whatever they, when they took the goods, whatever they handed you, that's the sale. This is the tricky part. The question becomes, which ones did you sell? And it's going to make a difference. It's going to make a difference on your income, and it's going to make a difference on your ending inventory. So I will be quiet, as quiet as I can be, and see if you can figure that out. Okay, so we'll go ahead and do the hard part together, kind of. We need the cost for 300 units, and that's just whatever the sales were. And the first ones in were here. So these are the first ones in. And there's only 120 in there. So we'll take the 120, obviously. At $5. And we still need the cost for how many?
$180.
Maybe.
So we got. Okay, so we still need the cost for 180. This layer is gone. So we go to the next first in. Which would be this. Now you don't need all 260. We only need 180. So from this layer, ninth. At 6. And you do not need to do this, but I'm just doing it to kind of round it out that we don't need the cost for anymore, but we found the cost for all 300. We have the 120 and the 80. You know, that's going to equal to 300. So, I mean, so it's kind of like this. You know, these layers have to equal that. Okay, let's play these out. Oops. Okay, so these are the sales. Easy. These are the costs. Not easy. Okay, let me see if I can. Hey, okay, so this would be sales or revenue. Sales and revenue are the same thing, so if you call that revenue, that's fine. Now the 1680, those are goods that left the place. These are no longer in the building. Gross profit is some number. 1920. Question, I think. Maybe a better question would be, did you get the same answer as I did? It's possible I did it wrong. But so I think that you got, is that what you guys got?
Yeah.
Okay. All right, now we gotta go to the ending inventory. We gotta clean this up a little bit up here because we do not have. We sold 180 units out of this. So what we really have left here is. $80. And we haven't done anything with this. They're down here, so. Yeah, we haven't. Okay, so this is what we're left with. This is our ending inventory. Ending inventory again is the stuff that's not sold. So we, oops. So the 120, that one's completely sold. I'm not gonna do that again, but this one's completely gone. This one we have 180 left, so there's only 80 left in it. So I'm just gonna copy these two down to do our ending inventory. All right. Okay, still have. So ending inventory, and it's really, but it also is the total cost of the ending inventory, and maybe a more, a better descripting. That, you know, the cost of the ending inventory is, well, it is just considered inventory. We're really talking about the cost of it. Okay, so we have. I think. That should be our ending inventory, 680. And again, this will, starting in February, the layer from 1.9 will be the first. Will be soon to be the first one sold, and then we'll go to the next one and so on and so forth. Any question on that thing? Okay. Last in, first out. You know, I think maybe I'll stop there. I'll stop here. The reason I don't know if I have enough time to get through this other one, to get through these other ones. We will save these for next class. Yeah, last one. I'll tell you a little bit about what the last in, first out is. It assumes that the last one's in where the first one's sold. And right now you're probably saying, how'd they come up with that? You know, it's not even possible, right? I mean, if you made a sale on January 5th, there's no way it came from January 10th. I mean, you didn't jump in the time machine and go forward or something. So you're probably wondering, why would anyone use this? Last in, first out. In other words, last one's in where the first one's sold. You say, well, that sounds pretty crazy. It doesn't make any sense. And I'll tell you something else. Last in, first out, the United States is the only country that uses it. You cannot use it on international standards. So you say, well, why is it? Why do we even have it? Well, here's why you have it. It comes from economists. It's theoretically, the most current price is the most accurate price for measuring income. Right. So the most current price, the latest price, is the best price for measuring your income because that is the market for whatever the goods are you're selling. So, you know, economists will tell us that it's, you know, that is the best price to use when you're trying to calculate your income. So when we go to our layers here, what that means is this last one in is the best estimate of what those items are really worth, what the true cost is this last layer. So it's not the actual flow at all. This is sort of a theoretical number that this is the best estimate of what those items are really worth. That's what the real cost is of those items. So LIFO is generally considered to give a more accurate income. You know, for economists, you know, we'll tell you that it is the most accurate as far as the income. It does not. It's not the actual flow. The actual flow is going to be FIFO usually. First one's in, first one's sold. This one is a theoretical one that gives the best estimate of what the ending the ending true cost of the inventory is. So they would say, okay, this is a better number. This number is ancient history. This is the best number as far as what is most accurate for determining your income. And that's why they use LIFO. Again, United States is the only country on the planet that allows this. And it's encouraged. And many companies will use this in the United States for this very reason. They feel it's a more accurate measure of their income.
Does it matter how many units you've sold?
Yeah. You know, you can go, you know, keep, you know, the number of units you sold will be, for instance, this one 45, these 45 will come out of this last 50. But yeah, as you go up the layer, the numbers get usually what economists would tell you they would get progressively worse, that these are not the, you know, the newest numbers, but, you know, they are part of the cost. So you have this, you do have this thing that the costs still matter, what you paid for it. But the latest ones that you bought will be the more accurate cost for it. There's also something weird that happens with LIFO, last in, first out. It's possible that some beginning inventory number never gets sold. This could be on the books for 100 years. You know, I mean, now with COVID, you know, you go into a grocery store and the stores are completely sold down to the, you know, they're bare shelves. So okay, yeah, they sold all of the inventory, right? But it is possible if they don't sell all the inventory, that this beginning inventory just hangs around. So think about this. This is going to be on your balance sheet, and it could have inventory that is, it's not, it could be 50 years old. You talk about companies like car companies or something like that that have been around for 100 years. Their costs, if they're using LIFO, they could have costs from the 1940s on their books because it never sells out completely. If it never sells out completely, this inventory just hangs on. And I think this is probably the biggest reason why other countries don't allow it. They say, wait a minute, you're gonna get some ridiculous number on your, you know, on your balance sheet, because it's gonna be, you know, back when you go to the movies for a quarter or something, you know, gas costs 19 cents, and you know that those are the numbers you have on your books. Any questions with that? So anyway, we'll go over this next time. So last in, first out is kind of a wacky method. It's only done in the United States. It is done quite a bit though in the United States, and also for taxes. A lot of companies use it for taxes. As of a couple of years ago, it's pretty much required. I haven't looked at the corporate tax code recently, but yeah. So it's not going to go away in the United States, but no other country uses it. And again, it is not the actual flow that we're looking at. It is a theoretical saying, look, the most accurate number is this last cost. This is the more accurate number. That's what you should use to calculate your income, not this older, less accurate number. And again, it's kind of like, here's kind of the flow. If you want to know like the overall of the different areas. Oops. It kind of goes like this. Economics are kind of what drives the, you know, and these can be kind of theoretical and, you know, this is sort of what drives management, finance and management decisions. You know, so this will be driving the decision. These are the decisions that people, well, people like you, mostly will be making. And accounting is really not about making decisions. Okay, we're looking at the historical costs. We're trying to put these into some kind of a context so people can make sense out of it. So economics is the theoretical. You know, how are you profitable? How do you make money? What's a good decision? That kind of thing. This is more the practical, taking the economics, which deals with sometimes utils of enjoyment and all these kind of crazy things, and says, okay, this is putting it into today's world and how do we do it? And accounting is really the record keeping. Is trying to figure out, okay, well, how do we take these decisions and these things that have happened and convey them in some form that people can look at. And so those are the financial statements, basically. So accounting is actually a passive activity for the most part. It's not active. We're not making the decisions. We're trying to record them. So accounting of you know, of all of these, this is, it's passive or historical. you know, in the past, which ones of these did we sell? It's historical. These transactions have already happened. And, you know, and accounting people didn't make these transactions. These are made by people working in the company. So accounting is sort of passive. It's historical. It's trying to record the transactions that have happened. Now, to record those, you have to understand them, though. You know, if it isn't that, you know, you be a knucklehead and be an accountant, you have to understand the transactions, or else you can't do the accounting for them. But it is passive in that we're not making the decisions. Management or the finance people are making the decisions, and we are generally looking at historical stuff. What happened and writing it down, like a journal. Question on that? So these are all linked, but it's just you know, different groups. And again, these are usually kind of out there. Sometimes they're not generally practical economic stuff. And you know, you guys been in your economics class, and they, you know, talk about the, you know, imaginary things, whereas these are actually people when you mostly what you guys are going to mostly be, and that is making decisions. You know, you're going to make decisions, and then oops. And in accounting is passive. We don't make the decisions, but we record them, and to record them, we have to understand them. Okay, enough of that. Okay, so we'll stop here. And we'll start up with LIFO on Tuesday. Any questions on any of that? Okay, well, I will see you guys on Tuesday, and I will talk to you later. I know there's still some stuff out there I gotta get graded. I graded most of the chapter 4 tests, and yes, I do accept late work. Turn it in, you'll get full credit. There's no penalty. It won't be in your grade until you do turn it in. Now, I know some of you have turned it in. I haven't graded it yet. I graded the chapter 4 exams. I need to, I'll go through and clean up the rest of it today. But yeah, so I do